is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles.
Rising and recurring crises on a global scale like the COVID-19 pandemic in 2020 or the Russia-Ukraine crisis or even the rising tensions in the Middle East have had a significant and growing impact on the financial markets around the world since the beginning of this decade. But what if the worst is yet to come? What if someone were to say that we are not at our worst point yet? Well, that is exactly what Jeremy Grantham is saying. But firstly, who is Jeremy Grantham? Roberto Jeremy Grantham is a British economist and investor who is also the co-founder and chief investment strategist of GMO LLC, an American investment organization. Over the years, Grantham has developed keen interest and a keen eye on financial markets and has been rightly able to predict market fluctuations for more than 50 years now. And his predictions? They've mostly been right. He correctly anticipated the bursting of the Japanese bubble in the late 1980s and the dot-com bubble in the late 1990s, and even warned the world about the oncoming housing bubble in 2008, which is considered to be the catalyst of the 2008 financial crisis. But coming back to the present and what Grantham has to say about the financial situations right now. The rising bullish enthusiasm at present would lead to an interest rate cut in the coming months, according to Grantham. An interest rate cut would drive the market up. Now, the news is not as rosy as it sounds. It is necessary to look at the historical data we have at hand. It is important to look at the 4 major economic bubbles in the United States that have happened in the last century in order to rightly understand the consequences of the upward climb better. The 4 major bubbles occurred in the years 1929, 1974, 2000, and 2007. In 3 out of the 4 years, that is in 1929, 2000, and 2007, the interest rate cuts were soon followed by market rate cuts, which goes on to reiterate the impact that a single interest rate cut can have when we take into consideration negative fundamentals as well. Now, it is also true that the opposite scenario has taken place. In 1974, the market actually rose up after a significant 62% real value decline in the 2 years that preceded it, which also coincided with the first rate cut by the Federal Reserve. But then again, it is not wise to let a singular incident overshadow the mixed results that the Federal Reserve has had over the last century, especially after the 2000 and 2007 first rate cuts. The 2000 and 2007 first rate cuts also show that the first rate cuts alone are not enough to bring the bear market to an end. This point has to be reiterated, as investors generally have a tendency to ignore historic downfalls and move ahead with a positive attitude, and this, by their own fault, leads them into a deep ditch. Now, Jeremy Grantham has actually warned us that the ongoing financial crisis has not really come to an end, and in fact, the phase 2 of the stock market crash is just about to arrive. He also highlights the various assets that investors could purchase, which continue to offer attractive returns and value propositions. According to an article that Grantham wrote for GMO, the first and easiest leg of the bursting of the bubble we called for a year ago is complete. The most speculative growth stocks that led the market on the way up have been crushed, and a large chunk of the total losses across markets that we expected to see a year ago have already occurred. Unfortunately for us, though, that is not where things end, and in reality, things are only going to get more complicated. At present, the valuations are nowhere close to the long-term averages, although they are in reduced form. And if historical data were to be trusted, these valuations have a tendency to overcorrect themselves below the trend line owing to deteriorating fundamentals. This is an outcome that is still very likely, but the timing and extent of the next market decline cannot be predicted with certainty due to the ever-changing landscape of the world. Additionally, there are other factors to be taken into consideration, like changing presidential cycle, the ongoing strength of the labour market, the reopening of the Chinese economy, and the subsiding inflation that could affect the pause or delay of the bear market. The level of deteriorating corporate fundamentals will determine the next 12 to 18 months, said Jeremy Grantham. Grantham also advises long-term investors to be wary of the changing interest rates and the potential downturn in the global property market, which would all weigh significantly on the economy both in the present and in the near future. Grantham also shifts his attention to the crisis between Russia and Ukraine, its consequences on the global market, and the uncertainty surrounding it. He lays his finger on how the crisis would impact the markets for grain, oilseed, and fertilizers. Russia's invasion of Ukraine created instability on a geopolitical level, and the end results of the invasion cannot be assessed right now. But what we do know is that the primary consequences, including limited energy supply and possibly affecting the vulnerable and developing nations that surround both countries. From both an economic as well as a financial perspective, the investors are never keen on the uncertainties, and most likely than not, uncertainties lead to negative outcomes, leading to the usage of the term polycrisis. Polycrisis refers to the occurrence of multiple catastrophic events simultaneously. According to Grantham, even if a single event were to spiral out of control, it could lead to a severe global recession that would make the 2008 global financial crisis look like child's play. According to Grantham, the most important factor to keep an eye out for would be the bursting of the housing bubble, which is more likely to have a more severe impact as compared to the decline in equities. And that would be just the beginning. While in the US there has been an extreme overpricing of the stocks, in other parts of the world like Vancouver, London, Paris, Shanghai, Sydney and Taiwan, it is the real estate markets that have shown cases of overpricing. Corrections in the real estate asset or real estate markets would take much longer than corrections in the equities market. And the real estate markets are directly linked to other markets and other sectors of the economy like construction or other related industries. This automatically makes it one of the most crucial indicators of an economic slowdown. And who would an economic slowdown affect the most? Grantham believes that the middle class would be the most affected, as they tend to rely on real estate and housing as part of their retirement plans. There would be a severe customer unease due to their vulnerability to declining housing prices. In fact, Australia and Canada, two countries that are considered to have a stable real estate market, have already begun seeing a decline in real estate prices. According to Reuters International, Canada has seen a 12% drop in just the last year, and estimates suggest that other markets considered to be overpriced are likely to follow suit. Grantham also goes a step further and takes the presidential cycle into consideration, which is a recurring event that has significantly impacted the markets over the years. He suggests that a change in the presidential cycle would prolong the bear market. He quotes historical data for this, according to which, in the months between October and the second year of April, or the third year of a presidential cycle, the returns for these 6 months have been equal to the remaining months of the cycle. Now, the actual probability of occurrence is low, but the fact remains that the trend has repeated itself over the last 45 years. Grantham also brings the relationship between market troughs into picture. The relationship between recessions and market troughs, especially during the bubble periods of 1929, 1974, 2000 and 2007, show different dynamics as compared to the usual systems of a bull market. Grantham mentions cases that the lowest points of the market materialize after a significant amount of time. Usually, recessions precede a bear market by almost 7 to 8 months, but when it comes to psychological bubbles, the bear markets could follow much later. Keeping this in mind, Grantham suggests that the final low for the current crisis could hit well into 2024 or maybe even 2025. But not all news is negative. Grantham also recommends investment opportunities that could still be considered reasonable. GMO's 7-year asset class forecasts reveal that the emerging markets are actually decently priced. Grantham also recommends equity dislocation strategy, which says it is better to take a long position in moderately priced stocks and a short position in overpriced ones. Although financial markets have been facing difficulties, it is quite possible that we aren't at the weakest point yet. But there are investment opportunities that are still viable. And when someone like Jeremy Grantham's caliber is one saying it, it is much better for our own good that we listen to it. For more similar updates, keep supporting us by liking, sharing and subscribing to our channel.